Thanks for coming in early, everyone. I appreciate you being here today. I'm going to show you a series of charts that I don't think you've seen elsewhere. At the end, I hope you agree with me that we are facing what I've shown here in the title, a stock market top for the ages. So train your eyes up to one of these screens and let's start. We're going to first look at a collection of references that people use to value the stock market. This is a 100-year plus history of a composite indicator relating stock prices to gross domestic product, corporate sales, corporate earnings, and corporate book values. You can see over on the left that you can go back to the early 1900s to see an extreme in that measure. Again in 1929, then in the late 60s at the go-go peak, then in 2000 when the tech mania was in full blast. Well, now we have reached levels that we have never seen before. We call this the everything peak because it's not only that stocks are overvalued, you've got real estate overvalued, you've got bonds overvalued, especially junk bonds. Across the board, you're seeing people investing to extreme levels. So that is an extreme valuation going as far back as we have data. Here are two more looks. On the left, you'll see a chart showing the S&P 500 as it relates to its 12-month moving sales. This is not profits. This is not earnings. It is sales. That means sales even of companies that are losing money, okay? Well, we're currently priced at 3 times sales, well higher than the 2000 high at 2.36. Now look over at the other chart and you'll see that we are currently trading at 2 times the quarterly U.S. economy. Now this is again unprecedented from previous readings. We've had previous readings around 150 back in the late 60s. It was down at 75%. We're now at 200%. Again, an all-time record. We've got record margin debt. That's how, one of the ways anyway, that we got in this position to begin with. You'll notice that at previous times when margin debt was extreme, the stock market would have a serious reaction. Well, here we are at closing in on $1 trillion worth of margin debt and all-time highs in the stock market and at all-time highs in margin debt. So people are borrowing to the hilt so they can own shares of stock. We also have an extreme low in people's interest in holding cash. Now, this is a chart showing the retail money market ratio as a percentage of the S&P's market capitalization. You can see back in 2009 in the middle of the chart, the ratio was 12%. That's quite a bit of cash relative to the value of stocks. We've just made a new all-time low here at 2%. So the amount of cash relative to the value of stocks is extremely low, in fact, historically low. Well, cash is being shunned by virtually everyone. The middle graph here shows you the amount of cash, the percentage of cash in mutual funds. Now we've inverted this line, so the higher it goes, the more bullish they are, the more they own stock as opposed to cash. And it's at an all-time record. It used to be that the stock market would top out when mutual fund cash got to 4%. Now it's less than 2%. Now look at the bottom chart. This is data from the Ridex money market funds. They have a lot of good data. We use it. Once again, we're at an all-time record low in the assets invested in cash versus the assets invested in bullish stock indexes. Now we're getting into some fascinating territory here. These are more Ridex data. In the middle chart, look over toward the left and you'll see the words normal range. This is the ratio between the amount of money that people have put into bullish funds at Ridex versus bearish funds. And in the old days, that is 15 years ago, it was trading around 1-to-1 or 2-to-1. So there was fairly even split. People are generally more optimistic than pessimistic. So there's a little bit more money in the bull funds than bear. People have been going crazy in the last 4 years. That ratio has now reached 40-to-1. There is 40 times as much money in the bullish funds at Ridex than in the bearish funds. And believe it or not, that's not even the craziest indicator on this chart. Now look at the bottom chart, the bottom graph. We've got a ratio of the leveraged bullish funds versus the leveraged bearish funds, and it shows that there is 70 times as much money in the leveraged bullish funds as there are in the leveraged bearish funds. That is incredible. It dwarfs anything in the past. It shows you that people are invested to the hilt, in fact, beyond. Of course, all of this optimism has brought us a new low for the past 2 decades in the put-call volume ratio. Again, the bottom graph here is inverted. The higher it goes, the more bullish people are. And they're trading calls more than twice as much as they are trading puts. Now, all of this call buying shows up in other areas. This is a chart of the large traders, buy to open call purchases as a percent of total option volume. And as you can see, it's another new all-time high. It's well beyond the high of early 2000. Again, a new record. The large traders are not alone. The small traders are doing the same thing. They're more invested in calls than at any time in history. They might think that the large traders are smart guys, but both they and the small traders tend to follow the market, so they buy as it goes up. They're maximum invested at tops, and the reverse happens, as you can see right on this chart, at bottoms when they're afraid and they're buying puts instead of calls. All of this call buying has resulted in a massive amount of money being poured into paying up for calls. This shows that $44 billion has recently been put into the premiums on calls. That is the amount of money above break even for the call in terms of the stock price that underlies it. Now look at these previous lows of previous peaks in the index over here at the bottom left and in the middle where we have the red arrows. Those are the big tops in the stock market of 2000 and 2007. And then it only took a ratio or a $7 billion amount to top out the market. We're currently at $44 billion. Again, dwarfing previous peaks. We also have record positions in leveraged long ETFs. These are exchange traded funds. They're baskets of stocks, or they trade based on baskets of stocks. And people are pouring money into these. And we're showing you here not just the long, the leveraged long. So they're betting 2 to 1 or sometimes even 3 to 1 on the stock market going higher. At the same time, we have record trading volume in penny stocks. 100 billion shares trading daily in the penny stocks. This dwarfs the 10 billion shares that was sort of the average for the previous few years. So people are going crazy in the penny stocks. At the same time, we have a record dollar volume of IPOs. This was the reading for 2020, dwarfed all previous readings. IPOs are initial public offerings of stock. Wall Street knows when the public's ready to throw money at it, and this is when it comes out and sells all kinds of shares of new issues called IPOs. Well, this year we've been running at an even higher pace, and the year's not even over yet. We also have, of course, a total number of IPOs plus secondary offerings that has reached an all-time record itself. Previous peaks back in the 90s were somewhere in the 150 to 180 range. We're almost at 300 on this index. This is an amazing statistic. There is currently a record multiple of money losing to money making IPOs. All right, so what does that mean? It means when people are coming out with new public offerings of stock, they're offering you shares in companies that are losing money at 12 times the rate they're offering you shares of companies that are making money. So 12 out of 13 of the offerings are for money-losing companies. and people are buying them up like hotcakes. They can't get enough. It's unbelievable. But it gets worse. This chart shows that there is a record value for firms earning too little to pay the interest on their debts. Now, you might wonder, how could a company even stay in business if it can't pay the interest on its debts? And the answer is they just borrow more money. And people are paying up to own these companies to a record amount, $2 trillion worth. Unbelievable. We also have a record number of deals for raising capital for what, you ask? Well, they won't tell you. Raising capital for no stated purpose. There are actually companies called special purpose acquisition companies, SPACs, and the IPOs of these have topped 400 already this year, and the year isn't even over yet. So what they're doing is they're saying, give us your money, and we'll figure out later what we're going to do with it. And people are going, what a great idea. I think I'll do that. This hasn't happened since the South Sea bubble in 1720. Here's a fascinating chart. Look at the bottom there, about in the middle, and you'll see a low for this chart that was in March 2020 when the stock market bottomed out. Goldman Sachs keeps an index of the prices of money-losing technology companies. And these things have gone up almost 5 times in value since March 2020. People can't get enough of money-losing companies to stuff into their portfolios. Unbelievable. All this excitement about tech companies, of course, has increased the volume of trading on the NASDAQ versus the S&P 500. Back in the dot-com era, when they called it a mania in the NASDAQ, even then they could only generate about 1.3 times the volume. Well, now it's at 2.5 and rising, which is double the ratio. If you thought that was a mania, what's this? Now, this is an interesting thing. There are surveys of money managers, and they ask them, are you taking more than normal long-side risk? And when they're really confident, they're happy to answer that question. Yes, I am. And this is the percentage of money managers who admit to taking more than normal risks. It's almost 20%. Regardless of what the number is, it's the highest we've gone on record. There is record long exposures among the most bearish money managers. Now, this is an indicator you probably haven't seen before. Look at the bottom of this chart. You'll see a lot of blue lines, and you see the 0 line there. What that means is when the blue line is below 0, the most bearish group of money managers is short. And when that line goes all the way to the bottom, it means that they're 200% short. They are short on leverage. On rare occasions, they get so bullish, they can't stand being short anymore, and they buy the market. 70% long is the average exposure right now for the most bearish money managers in the country. They are long. So who in the world is left to buy? Well, all this buying in stocks has pushed up the equity allocation among households as a percentage of total financial assets. You can see the peak of the go-go years at late 1968. You can see the March 2000 top. And now it's the highest ever. But what makes this number even more interesting is that this is despite the fact that real estate, where most people have their money, is also in a mania. And properties are priced at the highest levels ever. So this shows you that on a relative basis, stocks are even a bigger part of these people's holdings than they have ever been. Foreigners always come in and buy the market at the wrong time. They get interested around tops. You can look back in 2000, 2007, foreigners became very interested in buying U.S. equities. Well, they just set an all-time record in buying U.S. equities. They're always wrong at the turns, and this looks like another one to me. We developed our own little indicator here. This one is called maximum FOMO. What is that? Well, we do searches online to find articles about the stock market that include the term fear of missing out. Now, this term only became popular about 5 years ago, but look at the number of articles that include both the term stock market and fear of missing out. It's an all-time record by a huge amount in 2021. People are afraid of missing out, and they're expressing it to journalists. These are the kinds of headlines you're reading everywhere. This is just a snippet of some of them that came out in April. There's going to be a face ripper stock market rally. That means like you're on a roller coaster and going so fast your cheeks puff out, right? Except they're not talking about the downside. Like in a roller coaster, it's the upside. A professor tells us the bull market has just entered its third inning. That means he thinks there's going to be a fourth inning, a fifth, a sixth, a seventh, an eighth, a ninth, and maybe overtime. Long way to go. We're just starting. We're told to enjoy the ride. There's a super bull market. There's more room to run. Managers are incredibly bullish. The bull market is far from over. And my favorite one here is at the bottom right. It's the beginning of a multi-year boom. Never mind that the stock market's been going up for 12 years. We're just at the beginning. And here are a couple just from this week. Wall Street stock analysts echo the crypto bulls in seeing nothing but gains ahead. Now, you probably aren't old enough to remember Barron's headline in 1973, January. It said, "Not a bear among them." And that was the high just prior to the biggest decline in stocks since the 1930s. And I think we're seeing the same kind of thing again. And just yesterday, we saw this headline. One of the most bullish firms on Wall Street just hiked its S&P 500 price target. Well, of course they are. They're so bullish they can't help it. Now, here's an indicator you probably haven't seen. Steinbach is a company in Germany that makes nutcrackers. You know, those things you put on the mantle, you put on the hearth around Christmas time. Well, this year they came out with the Wall Street Kid. If you haven't been reading about Wall Street Kids, these are the young people who live in their parents' basement and trade on their apps on their phones all day long. So they're commemorating this person. They call him Diamond Hands. Why? Because when they buy something, they hold on to it and they're proud of it. They don't sell. They hold on as hard as diamond to those long positions. And you know what? I'll recommend you go ahead and get one of these for yourself. It's probably going to be a collector's item. There's only one group of people who aren't bullish and buying their heads off, and that is corporate insiders. This is the record reading you've got here on the insider sell versus buy ratio. These are corporate officers who know what their companies are worth, and they're selling their heads off at a rate of 8 sells to every buy. So you've got a decision to make. You can agree with all the people on the previous 27 slides, or you can go with the corporate insiders who are selling into this mania. Well, that's about it for me. I hope I've shown you that we are facing a top for the ages in the stock market. I would like to thank you for your time today. It's always fun when I can run through some charts, because charts are what the markets are all about. And when they're all on one side of the ledger, they're giving you a message, and I hope you're listening to it. Have a great day. Enjoy New Orleans, and hope to see you in person next year.